Another white-knuckle day unfolding on Wall Street, and this time it's official.
Yeah.
U.S. stocks have plunged into bear market territory.
Wow.
Despite efforts by President Trump's advisors to downplay the growing unease, confidence among business leaders is clearly crumbling.
Makes sense.
There's no denying it now.
Yep.
The markets are in turmoil,
Definitely in turmoil.
and there's no clear sign of a turnaround in sight.
Yeah.
Given this stark reality, it feels like a pretty crucial time to look back at how others have navigated similar storms.
I think so too.
So today on the deep dive, we're going straight to the source,
Okay.
delving into bear market investing strategies by Harry D. Schultz.
All right.
Our goal isn't just to understand what happened in the past, but to really pull out some fundamental insights that can help you, our listener, make sense of this environment and maybe even spot some opportunities that might otherwise be missed.
Yeah, that sounds like a great goal.
So to kick things off, one of the things that really struck me early on in the book is how Schultz challenges this idea that you can perfectly predict the market. He argues that market analysis is much more of an art form.
Oh, interesting.
It relies heavily on intuition and experience as we try to make sense of all this ever-shifting data.
Right. It's always changing.
It's not a hard science with guaranteed formulas.
Yeah, I can definitely see that.
What are your initial thoughts on that idea that market analysis is more art than science?
You know, it makes a lot of sense to me because if you think about it, there are so many factors that influence the market beyond just the numbers.
Totally.
Like we have human psychology, fear, greed.
Oh yeah, for sure.
You've got unexpected global events that can completely throw things off.
Absolutely. And all of those things are so hard to quantify.
Right. They're unpredictable.
And software, it can maybe identify patterns in past data,
Yeah, like historical trends.
but it can't really grasp, the nuances of how those human elements and those unforeseen events will actually play out in the real world.
I think that's where the art comes in, the ability to interpret the data, to weigh those different factors.
Like developing a feel for the market that goes beyond just crunching numbers.
Exactly.
I mean, he even uses this example of all this new software that popped up before the dot-com crash.
Oh, yeah, I remember that.
Everyone was promising to perfectly time the market based on just a few years of historical data.
Yeah, everyone thought they had it all figured out.
And then when the market actually turned, all those supposedly magical solutions just fell apart.
Because the landscape had changed.
Yeah, and it really highlights the need for us to understand those deeper market fundamentals, right?
Absolutely. It's not enough to just rely on algorithms or past performance.
So then with that idea in mind, let's shift to how Schultz approaches the mindset that's needed in a bear market.
Okay.
It's probably not what a lot of people initially assume.
Oh, really? How so?
Well, he kind of flips the script on how we normally think about bulls and bears. He suggests that a true bear isn't actually just a perpetual pessimist.
Okay.
In fact, he argues that they can be quite optimistic in the long run.
It's interesting.
So what's your take on that? How can someone be a bear and still be optimistic?
Well, the way I see it is that Schultz is saying that the real pessimists are actually those who are always bullish. The ones who believe that the market will always go up.
They're just kind of blind to the possibility of a downturn.
Exactly. And they're the ones who get caught off guard when the inevitable correction happens.
Okay.
The true bear, on the other hand, they acknowledge that market cycles exist.
They understand there will be ups and downs
Right. And they actually prepare for those downturns.
by being bearish when the market calls for it.
Exactly. And because they understand that declines are temporary, they can maintain a long-term optimism that the economy and the markets will eventually recover.
So it's not about being negative all the time. It's about being realistic and recognizing the cyclical nature of the market.
Precisely. And I think Schultz is arguing that realism is ultimately a form of optimism because it allows you to weather the storms and come out stronger on the other side.
And be more prepared for the next one. So it's about being what he calls a flexible realist.
Yeah, someone who's willing to adapt their thinking as the market changes.
Not being dogmatically attached to being a bull or a bear.
Right. It's about being able to see the market for what it is at any given moment.
And it actually reminded me of something you said earlier about how you define your own investing mindset. Do you think of yourself as more of a bull or a bear, or do you try to stay flexible?
I really try to avoid labeling myself as one or the other because I think it's dangerous to get too attached to a particular viewpoint.
Yeah, you can get stuck in a rut.
Exactly. I aim to be a flexible realist, like Schultz describes.
Okay, so you're ready to shift your perspective as the market dictates.
Absolutely. I'm always reassessing the situation, looking at the data, and trying to adjust my strategy accordingly.
Now let's tackle a topic that I know can be a bit controversial, short selling.
Okay.
Schultz dedicates a significant portion of the book to demystifying short selling and pushing back against this idea that it's somehow unpatriotic.
Interesting too.
Can you walk us through some of his core arguments there?
Sure. So basically, Schultz starts by clarifying that short selling is simply the reverse of a typical buy low, sell high strategy.
Okay.
When you short sell, you're borrowing shares of a stock and selling them at the current price,
Right.
and then hoping to buy them back later at a lower price and pocket the difference.
Got it.
So he points out that regulatory bodies like the SEC permit this activity, so it's a legitimate part of the market.
It's not like some shady backroom deal.
Right, it's regulated.
Okay.
And then he goes on to argue that a healthy economy doesn't actually depend on everyone constantly making money in a rising market.
So it's okay for some people to profit when
Yeah.
prices are going down.
Exactly. He's saying that allowing investors to profit from declining prices can actually be a sign of a more robust and flexible system.
It's all about different perspectives and approaches.
Right.
Yeah.
And allowing for different ways to participate in the market.
And he makes this really crucial distinction that I thought was important.
What's that?
He says that shorting a stock isn't the same as betting against the company itself.
I see what you mean.
You're essentially expressing an opinion on the stock's current valuation.
It's a bet on the price, not the company's overall success.
Exactly. And the company doesn't directly lose money if its stock price falls due to short selling.
Right. It's a transaction between investors.
To further illustrate that short selling isn't some nefarious modern invention, he reminds us of figures like Joseph Kennedy,
Oh, wow. President Kennedy's father.
right, who famously profited by short selling during the 1929 bear market.
So it's a strategy that's been around for a while.
Yeah, and I think the point he's trying to make is that these individuals weren't trying to harm the country or undermine the economy.
They were just operating within the existing market conditions.
And I think that's a really important point to emphasize.
Yeah, it's about understanding that short selling is a tool just like any other investing strategy.
It could be used for good or for bad.
Right. And it's important to understand the risks and potential downsides before engaging in it.
Absolutely. Okay, so moving on, Aber. Schultz frequently cautions against directly comparing different bear markets. He uses the saying, history doesn't repeat, but it rhymes.
Oh, I like that.
So what's the crucial distinction he's making there? What do you think he means by that?
Well, I think what he's getting at is that while we can certainly learn from past bear markets,
Yeah, study the patterns.
we can't expect the future to unfold in exactly the same way.
Yeah, no two bear markets are exactly alike.
Right, there might be some superficial similarities in the numbers or the speed of the decline.
But the context is always different.
Exactly. The underlying cultural, political, and economic factors at play in each bear market are unique, and they'll significantly influence its trajectory and duration.
And he uses this example of the Fed's aggressive interest rate cuts after the year 2000.
Oh, yeah.
And the thinking back then, based on the relatively quick recovery after the 1987 crash, was that similar action would lead to a similar result this time around.
Right, cut rates stimulate the economy and everything bounces back.
But it didn't quite play out that way.
No, it didn't, and I think that's a great example of how we can't just blindly apply past playbooks to current situations.
We have to consider the specific circumstances of the time.
Exactly. History can inform our decisions, but it can't dictate them.
So in the book, he briefly mentions a bunch of different historical bear markets, stretching all the way back to the early 20th century.
Oh, wow.
Like the panics of 1903 and 1907, the downturns of 1917, 1946, and of course more recent ones like 1981, 1984, 1987.
It's amazing to see how these cycles have played out over time.
Yeah, and I think the key takeaway from all those examples is that each of these periods had its own set of circumstances.
Its own unique story.
Right, and while studying them can provide us with valuable context, we can't simply apply those past playbooks to today's situation.
We have to adapt our thinking and our strategies to the present moment.
Now, this connects to something else that he talks about that I wanted to get your thoughts on.
Okay.
He has this warning about technology and how it can potentially foster what he calls lazy thinking.
Interesting.
What do you think he means by that?
Well, I think what he's getting at is that with the rise of all these sophisticated trading software programs and algorithms, investors might be tempted to rely too heavily on them.
Like blindly following the signals without really understanding what's going on.
Exactly. He's concerned that people are becoming overly reliant on these tools and losing sight of the fundamental drivers of the market.
So it's not that the technology is inherently bad.
No, not at all. It can be incredibly useful.
but it's how we use it that matters.
Right. We can't let it do our thinking for us.
We still need to engage our own critical thinking skills.
Absolutely.
And he specifically mentions this belief that took hold after 1995 that the Fed would always intervene to prop up the market.
Ah, the Greenspan put.
Yeah, and he felt like that led to a form of complacency among investors.
Like a false sense of security.
Yeah, people started to think that the old rules of market cycles no longer applied.
That the Fed had everything under control.
But as we're seeing now, that's not necessarily the case.
No, the market can still surprise us.
So with all that in mind, let's talk about some of the key signs that Schultz suggests might indicate that a bull market is reaching its end.
Okay.
I'm curious to see if we can identify any of these signals looking back at the period before this current downturn.
Yeah, let's see.
So what are some of the red flags that he points to?
One of the most prominent signs he mentions is this widespread bullish sentiment that persists even as the underlying economic fundamentals start to weaken.
So people are still optimistic, even though the data is suggesting trouble ahead.
Exactly. It's like they're ignoring the warning signs.
They're caught up in the euphoria.
Right. And another sign he points to is excessively high price-to-earnings ratios.
That's always a classic warning sign, right?
Yeah. It suggests that the market might be overvalued.
Like the stock prices are out of whack with the actual earnings potential of the companies?
Precisely. And he even references Robert Shiller's work on irrational exuberance.
Oh yeah, the idea that markets can get swept up in speculative bubbles.
Exactly. And he uses the historical average PE ratio to kind of gauge when valuations might be getting dangerously stretched.
Okay, so those are two big ones. What else did he mention?
Well, he also talked about the ineffectiveness of Federal Reserve interest rate cuts as another potential red flag.
So even when the Fed tries to stimulate the economy, it's not having the desired effect.
Right. The market is no longer responding to those traditional measures.
Interesting. What else?
Well, he also mentioned very high levels of consumer and investor confidence right at market peaks.
So everyone's feeling great right before things start to fall apart.
It's a classic case of buy when others are fearful.
Right.
And you might also see what he calls churning in the stock market.
Churning. What's that?
It's basically when you have high trading volume, but relatively little movement in the overall prices.
So a lot of activity, but no clear direction.
Right, or a lot of erratic up and down swings without a clear trend.
It's like the market's trying to figure out where to go.
Exactly, and another interesting indicator he mentions is the overwhelming agreement of bullish forecasts among business leaders and analysts.
So everyone's saying the market's going to go up.
Right, and Schultz argues that this kind of unanimity can actually be a contrarian indicator.
Like when everyone's thinking the same way, it might be time to start thinking differently.
Precisely.
And finally, he talks about a significant increase in overall debt levels as another potential warning sign, both for individuals and corporations.
Right, too much debt can make the system vulnerable to shocks.
It's like a house of cards.
Exactly.
So looking back at the period leading up to this current market downturn, do any of those signs ring a bell?
It's definitely worth considering.
Yeah, it's a good reminder to always be looking for those underlying trends and not just getting caught up in the hype.
Absolutely.
Now, in today's increasingly interconnected world, Schultz also discusses the role of globalization in bear markets.
Yeah, the world is so much more interconnected than it used to be.
How does that factor into his analysis?
Well, he emphasizes how economic problems in one major country can quickly spread and impact others.
Like a domino effect.
Right. He uses the analogy of a house of cards to illustrate how fragile the global economy can be.
So even if your investment portfolio is primarily focused on domestic assets, you can't afford to ignore what's happening in other parts of the world.
Exactly, because those events can often be leading indicators of potential trouble at home.
So it's a reminder to think globally when assessing market risks.
Absolutely.
Okay, let's dive into the mechanics of a bear market itself.
Okay.
Schultz talks about secondary reactions. What are those, and why are they important for investors to understand?
So in a bear market, the primary trend is downward, right?
Right, prices are generally falling.
But within that overall decline, you'll often see these temporary upward movements.
So like brief rallies within the larger downtrend?
Exactly, and those are what Schultz calls secondary reactions or bear market rallies.
Got it.
And he points out that these rallies can occur multiple times during a bear market.
So it's not just a one-time thing.
Right, and they're significant for a couple of key reasons.
Okay.
First, they can provide opportunities for investors who missed the initial peak to sell some of their holdings at somewhat higher prices.
So it's like a second chance to get out?
Yeah, before the market potentially drops further.
Okay.
And second, they can also be strategic entry points for those looking to initiate short positions.
Betting on the overall downward trend to resume.
Exactly.
So if you missed selling at the peak, these rallies might be your last chance to get out at a relatively better price.
Before the next leg down.
Got it.
But he also mentions a potentially deceptive period that can follow these rallies.
Well,
He calls it dullness.
Dullness, okay.
And it's basically a period of low trading volume and minimal price fluctuations after a bear market rally reaches its peak.
So it's like the market's taking a breather.
Yeah, but Schultz warns that this can actually be a trap for investors.
How so?
Well, it goes against that common saying in bull markets, never sell a dull market.
Right, because in a bull market, a quiet period might just mean that the uptrend is consolidating.
Exactly.
But in a bear market, it's different.
Yeah, this period of quiet can often precede the next significant leg down.
Oh, wow. So it's like a false sense of security.
Precisely.
So beyond understanding these different phases of a bear market, what are some of the practical tools and indicators that Schultz suggests investors can use to navigate these turbulent times?
Well, he introduces a bunch of different technical analysis tools,
Like what?
but he really emphasizes that these should always be used to support your own judgment and understanding, not as automatic buy or sell signals.
So they're not magic bullets.
No, they're more like guideposts.
Okay.
So one example he gives is tracking new highs, new lows.
What's that?
It's basically looking at the number of stocks hitting new 52-week highs versus those hitting new lows.
Okay.
And by analyzing the moving average of this indicator, you can get a sense of the underlying strength or weakness of the market trend.
So if more stocks are hitting new lows than new highs, that's a bearish signal.
Exactly.
And vice versa.
Right.
What other tools does he mention?
Another one he talks about is the odd-lot trading ratio.
What's that all about?
It's basically looking at the trading activity of smaller individual investors.
Okay, the little guys.
Yeah, and the idea is that their collective sentiment can sometimes be a contrarian indicator.
Oh, interesting. So if the small investors are panicking and selling heavily, it might actually be a good time to buy.
Exactly. They're often wrong at the extremes.
Wow. That's a really interesting way to look at it.
Yeah, and he also stresses the importance of analyzing trading volume.
To understand who's really driving the market.
Exactly. Is it large institutional investors or the general public?
So volume can tell you a lot about the conviction behind the price movements.
Right.
Okay. And then he also mentions the DJIA 30-week moving average and various overbought, oversold indicators.
Right, those are kind of classic technical analysis tools.
What's the general idea behind those?
So the 30-week moving average of the DJIA can act as a longer-term trend line. And generally, during a bear market, the market price tends to stay below this moving average. And during a bull market, it tends to stay above.
So it's a way to kind of gauge the overall direction of the market.
Right.
And what about overbought, oversold indicators?
Those are basically designed to identify when a market might have moved too far too fast in either direction and is potentially due for a correction.
So it's like a momentum indicator.
Exactly. There are various ways to calculate these, but the underlying principle is to look for extremes in trading activity that might signal a temporary reversal.
Got it.
So the key takeaway here is that there are a lot of different technical tools that investors can use to supplement their fundamental analysis.
But it's important to understand these tools and develop a feel for how they behave in different market conditions.
Right, they're not foolproof.
Now, a recurring theme throughout the book is this idea that emotions play a huge role in investing,
Oh, absolutely.
especially during volatile periods, like bear markets.
When fear and greed are running high?
Yeah, and Schultz really stresses that our emotions can be our biggest enemies in the market.
It's so easy to get caught up in the moment and make irrational decisions.
Totally. So how do we combat that? How do we keep our emotions in check?
Well, Schultz emphasizes the importance of cultivating a contrarian mindset,
Going against the crowd.
especially at major market turning points.
So when everyone's panicking, that's when you should be looking for opportunities.
Exactly. He even quotes that famous saying attributed to Baron Rothschild, buy when there's blood in the streets.
Wow, that's a powerful image.
It really underscores the idea of capitalizing on extreme pessimism.
Going against the herd mentality.
Right, and he also touches on this concept of the market as a voting machine, in the short run, heavily influenced by emotions.
But as a weighing machine in the long run, driven by fundamentals.
It's that classic quote from Benjamin Graham and David Dodd.
Right, and it's a really important distinction to keep in mind.
Because it reminds us that while the market can be irrational in the short term, in the long term, It tends to reflect the underlying value of the assets.
So don't get too caught up in the day-to-day fluctuations.
No, that's on the long game.
Okay, so with all these insights in mind, what are some of the specific strategies that Schultz recommends for navigating bear markets?
Well, he suggests a number of different approaches.
Like what?
One is to be prepared to sell out of positions during those bear market rallies we talked about earlier.
So using those rallies as opportunities to reduce your exposure.
Exactly.
Okay, what else?
He also discusses short selling as a strategy, but with a strong emphasis on the importance of using stop-loss orders.
To limit your potential losses if the market moves against you.
Right.
And he also advocates for never fighting the primary trend. So initiating short positions during confirmed downtrends and covering those shorts during upward reactions, and then looking to short again when the downward trend resumes.
It's about working with the market, not against it.
And of course, he reiterates that fundamental rule of investing,
Cut your losses quickly and let your profits run.
which is easier said than done.
Oh, definitely. It takes discipline.
But it's essential for long-term success.
Absolutely.
Finally, Schultz emphasizes that the primary goal during a bear market should be the preservation of capital.
Protect what you've got.
So what kind of defensive strategies does he suggest?
Well, he mentions gold as a traditional safe haven asset in times of economic uncertainty.
Gold, yeah, that's a classic.
Whether the prevailing risk is inflation or deflation.
Although he notes that it tends to perform particularly well during inflationary periods.
Right.
And he also advises investors to carefully reassess their real estate holdings,
Based on the specific economic environment.
whether it's an inflationary or deflationary recession, and to adjust their strategies accordingly.
So it's about being adaptable and responding to the changing conditions.
So the main takeaway here is that bear markets, while challenging, can also present opportunities.
If you know how to navigate them.
Right, it's about understanding the risks and adopting a more cautious and defensive approach.
Focused on preserving capital and selectively taking advantage of shorter-term opportunities within the overall downtrend.
And as we've explored today through the lens of Harry D. Schultz's bear market investing strategies, the wisdom gleaned from past downturns can offer valuable insights for navigating today's market climate.
It's all about learning from history and applying those lessons to the present.
And ultimately, it comes down to maintaining a critical and objective perspective, resisting emotionally driven decisions, and committing to continuous learning and adaptation in this ever-evolving market landscape.
That's the key to success in any market environment.
So as we wrap up this deep dive, I want to leave you with a question to ponder.
Okay, I'm listening.
Considering all the historical patterns and psychological factors we've discussed, what is one assumption you might currently be holding about this bear market that you should now take a moment to critically question?
That's a really good question.
It's all about challenging our own biases and assumptions.
And staying open to new information. Well, I think this has been a really insightful discussion,
I agree, we covered a lot of ground.
and I hope our listeners found it valuable.
Me too. We encourage you to explore Harry D. Schultz's book or any of the technical analysis tools we mentioned today.
There's always more to learn.
Thanks for joining us for this deep dive.
It's been a pleasure.